Welcome back, my awesome people. In today's episode, I will be highlighting how you can literally live off your stock's dividends. And this is called the 4% rule. I will show you how this happens and how much you will need to invest to make more than $35,000 in income per year, just from holding your dividend stocks and never selling. So stay tuned to the end to find out how. For most investors, a safe and sound retirement is priority number one. However, living off your investments once you finally retire can be as challenging as saving for a comfortable retirement. The famous 4% rule thrives on this fact. The 4% rule seeks to provide a steady stream of income from your dividend portfolio each year without selling shares or reducing your principal. And one way to enhance your retirement investing is to invest in dividend-paying stocks, mutual funds, and exchange-traded funds, or ETFs. Over time, the cash flow generated by these dividend payments can help with your retirement and pension income, as it is highly possible to live off those dividends if you just do a little planning. With a modest 8% annual return, you could accumulate over $450,000 by investing $500 a month for 25 years, while only contributing about $150,000 and the rest coming from reinvesting your dividends. And after 25 years, you will be able to withdraw approximately $35,000 annually, or about $3,000 a month. And this income is on top of the income from your day-to-day job and side hustles. Stock dividends tend to grow over time, unlike the interest from bonds. That's one of the main reasons why stocks should be a part of every investor's portfolio. Dividend growth has historically outpaced inflation. For those investors with long timelines, this can be used to create a portfolio that is strictly for dividend income living. A smart strategy for people who are still saving for retirement is to use those dividends to buy more shares of stock. That way, they will receive even more dividends and be able to buy even more shares. For example, assume that you bought 1,000 shares of a stock that traded for $100 for a total investment of $100,000. The stock has a 3% dividend yield, so you receive $3 per share over the past year, which is about $3,000 in dividends. You would then take those dividends and buy more stock, so your total investment is now $103,000. And assume that the stock price doesn't move much, but the company increases the dividend by 6% a year. In the second year, you will get a dividend yield of 3.18% on $103,000 for a dividend of about $3,275. After 10 years, the portfolio will produce around $7,200 in dividends. After 20 years, you will receive more than $25,000 a year in dividends. Compounding of dividend income is very advantageous if you have a long time horizon. But what about if you are near retirement? Well, for those investors, dividend growth plus a little higher yield could do the trick. Retired investors looking to live off their dividends may want to increase their yield, as this will go a long way toward helping to pay bills without selling off any shares. And on the other hand, while an investor with a smaller portfolio may have trouble living off dividends completely, the rising and steady payments still help reduce their principal withdrawals. By investing in quality dividend stocks with rising payouts, both young and old investors can benefit from the stock's compounding and historically inflation beating dividend growth. All it takes is a little planning, and then investors can live off their dividend income. The 4% rule states that you should be able to comfortably live off of 4% of your money in investments. Based on historical data, living off of just 4% will allow you to use your retirement portfolio to cover expenses for another 30 years after retirement. Financial advisor Bill Benyon designed the 4% rule in the 1990s as a way to cover your costs throughout retirement while making your money last as long as you can. Historical stock market data led him to the 4% target. By considering both average returns and unexpected events like the 1929 market crash, he determined that a retirement portfolio made up of 60% stocks and 40% fixed income assets should last over 30 years if you withdraw only 4% of the total annually. To figure out how much money you need to save before you can retire, you'll want to first estimate how much money you'll spend each year in retirement. To do this, you should consider the following costs: rent or mortgage, healthcare and long-term care costs, annual cost of groceries, annual cost of medication, transportation costs, and any other expenses that you may have. Knowing how much money you'll need to have saved up before you enter retirement can give you an idea of how much money you should be putting away right now in order to reach that goal. Once you know how much you need to save now, it's time to start putting it into practice. Retirement expenses aren't the same year in, year out. Lifespans aren't always predictable either. Here are some key risks to consider before you begin this spending rule. First is the sequence of returns risk. If the market experiences more downturns than upturns early in your retirement savings may not last as long as they would if the down years came later. Secondly is health risk. Aging means more doctor's appointments and medical bills in retirement for the average 65-year-old. With these additional expenses, as they are often unplanned and unexpected, can be risky, so it's important to plan ahead. Third is market risk. You've heard it before. History doesn't guarantee future performance. We could see unprecedented periods of inflation and market crashes that can greatly affect the 4% rule. And finally, Social Security and pension risk. The 4% rule assumes that you'll also receive the full Social Security benefits, but there's a chance these payments could decrease by the time you retire. So with these risks in mind, here are alternative strategies to the 4% rule. First is spend more conservatively. As volatility has increased and we enter risky periods in the markets, you might need to spend less in retirement to feel secure that you won't outlive your savings. For example, you can start withdrawing just 3% of your portfolio and then increase your withdrawals during better years, or even every year if you're comfortable. Second is maximize your other income sources. If you're able to cover your retirement expenses with other income, you could conserve more of your portfolio. If possible, consider delaying your Social Security payments until age 70. This way, you'll receive your maximum monthly benefit while accumulating more dividends. Whether you withdraw 3% or 4% from your portfolio, just having that ability to do so is life-changing. So start investing. So Jacob Rant, what is your end goal here? Are you a dividend investor because you want to follow the 4% rule, or are you following a different rule? Yes, my awesome people, that is exactly why I started investing. Many investors invest for the now, meaning growth stocks and day trading to make money now and use as they wish. And then there are other investors where they're using the money they have now to build a foundation for the future. And me, I am investing to build a foundation for the future so I can retire from my job and live off my passive income. And not only that, but I can also transfer my dividend stocks to my family and pass it down for generations to come as a way to build generational wealth. Imagine your great-grandparents buying and holding Coca-Cola stocks 100 years ago. Well, their grandkids will now be able to pursue their dreams and passions without having to worry about money, as they now live off the massive quarterly dividends from their Coca-Cola shares and can have a financial head start in life when compared to other families who never invested. As the great Malcolm X stated, the future belongs to those who prepare for it today. And remember, my awesome people, just like all the information I mentioned in my videos, assess your risk appetite, always diversify, and please, please, please do your own due diligence, because I am just a clown on YouTube. Stay ranting.